This video examines a classified market briefing from July 2026. We are looking at Operation Shellgame, a tactical breakdown of market maneuvers, including window dressing, calculated media leaks, and coordinated sentiment shifts that allowed certain sectors to profit while others experienced volatility. In this video, we will analyze the disconnect between the market carnage narrative and the actual price movement. We will explore the mechanics of a window dressing unwind, the implications of the Meta NeoCloud leak, and how to track smart money crossovers and internal market breadth. Following the June 30th high, the Semiconductor Index, or SOX, saw a 14% drawdown in just 2 trading days. This video investigates whether this sharp decline indicates systemic risk, or is merely the result of market participants reshuffling their positions. While market sentiment is screaming carnage, the reality shows that the index has barely moved. Identifying the gap between this market noise and the actual tape is essential for understanding where the true trading opportunities lie. Is this a systemic break, or simply a window dressing unwind? The market data presents a different picture than the headlines. While the Dow hits all-time highs and market breadth improves, headlines focus on the 14% SOX drop and specific tech sell-offs. This video follows a structured roadmap. We will dissect the anatomy of the window dress, examine market internals, analyze the institutional versus retail crossover, and look at the, quote, three-legged stool framework used to navigate these market conditions. Part 1 focuses on the shell game. There is a common belief that window dressing is a myth, but this video will demonstrate how clearly observable these events can be within the market cycle. Window dressing involves funds buying end-of-quarter winners to project a specific image to investors. This forced buying creates artificial price increases. Once the quarter closes, these same entities often become sellers, manufacturing fear to provide the liquidity they need to exit their positions. The anatomy of a window dress follows a 5-step process: quarter-end accumulation, the resulting markup, the subsequent need for an exit, the arrival of a timely story to drive fear, and the final handoff where institutional sellers offload into retail panic. This chart illustrates the 48-hour round trip of the SOX index. The rapid 12% gain leading into the quarter end was entirely erased, highlighting the volatility associated with these end-of-period maneuvers. A 12% move in the semiconductor index over 48 hours is rarely an organic market event. It is a clear signature of the window dressing process occurring just before the quarter ends. On June 30th, the SOX index closed at 95% of its range, with the peak print reaching 99%. Marking the index at its high point is a classic indicator of these end-of-quarter window dressing tactics. The timing of news is critical. By dropping maximum fear headlines into a light-volume holiday week, market participants were able to leverage thin liquidity to create an air pocket. This allowed window dressers an easier path to exit their trapped positions. We observed a coordinated social media effort claiming a drop in DRAM prices, which contradicted actual daily spot market data. When identical claims appear simultaneously across multiple platforms, it suggests artificial pressure rather than organic analysis. The 5-day timeline highlights the sequence of events, from initial window dressing on June 30th, through the news-driven fear and social media amplification, to the final unwind and market divergence observed by July 3rd. Moving to CoreWeave, a key point here is that Meta is one of their largest customers. We've seen significant stock sales by the CEO recently, and the market showed a complete lack of support during the sell-off. Insider selling of this scale suggests they aren't bullish, and the timing of these sales relative to market headlines warrants close scrutiny. The shell game in one sentence: be cautious in areas where manipulators can influence the narrative. Monday often sees window dressing, Tuesday brings bad news, Wednesday intensifies the fear, and by Friday, international markets may recover as retail investors are shaken out. South Korea's index, EWY, highlights that smart money often buys the dip while retail is still panicking. A 5% gain on Friday demonstrates that major infrastructure buildouts continue, regardless of rumors or temporary market volatility. Part 2 examines market breadth. While public headlines are designed to create a narrative, internal market data provides the objective truth, the receipts of market activity. We prioritize breadth because market participation is difficult to fake, unlike price or narrative. Breadth often deteriorates before a market top and improves before a bottom. Our key question during headline-driven volatility is simple: is participation expanding or contracting? This chart shows the stacking of market breadth. By monitoring these levels, we can track participation trends that often contradict the prevailing market mood. Remarkably, as headlines focused on market carnage, the percentage of S&P stocks above their key moving averages actually strengthened throughout the week, rising from 65 to 72%. It is rare for breadth to improve while the market remains stagnant. This divergence suggests that the current conditions are building toward a significant move. It's not a matter of if, but when. The new highs minus new lows spread is perhaps the cleanest signal available. It tracks the raw difference between stocks hitting new highs and lows. When this spread rises even as the price falls, it indicates that supply is being absorbed by the market. This chart illustrates the movement of the nitrogen monohydride NL spread, showing how it functions as a leading indicator for market turning points. Looking at May 15th, the nitrogen monohydride NL spread hit its low before the price index did. Despite the market looking weak and sentiment being negative, the spread told us that supply was drying up, successfully front-running the eventual recovery. A similar setup occurred on June 23rd. The breadth spread improved, even as the market experienced a final flush. This pattern reinforces that the signal can provide an edge by identifying when supply is exhausted, allowing for entry before the turn. The NDFI, the percentage of NASDAQ 100 stocks above their 50-day moving average, remains aligned with the broader market. It suggests that the perceived weakness in the index is consolidation, rather than a distribution phase. This ratio of the S&P 500 to the NASDAQ 100 provides a visual representation of how these indices are interacting during recent market maneuvers. Despite all the talk of market rotation, the total range for the S&P and NASDAQ ratio was less than 4%. It serves as a reminder that the actual magnitude of these shifts is often much smaller than the narrative suggests. We are now looking at the ratio of the S&P 500 to the NASDAQ 100. This chart shows an inverse head and shoulders pattern, which often signals a shift in market momentum. The RSI is also showing a higher high, suggesting a potential breakout in relative strength for the S&P. The current setup reveals that S&P underperformance relative to the NASDAQ has reached levels not seen since the dot-com era. This suggests the S&P is positioned to catch up, making diversification a prudent consideration. However, always trade with calculated position sizing rather than conviction. Market indicators are showing clear signs of broadening. With new highs to new lows rising and NASDAQ internals remaining aligned, the S&P is coiling for a potential move. This behavior is distinctly different from what a market crash looks like. Part 3 of our briefing explores the smart money versus dumb money dynamic. We define these terms not as fixed states of being, but as institutional versus retail order flow, which provides a much more practical way to track market participants. It is a mistake to label one group as always right and the other as always wrong. During the recent "liberation era," retail investors remained long, while institutions sat on the sidelines, and retail ultimately won that round. We don't worship either line. We watch how they interact. Speed is the key differentiator. Institutions move slowly, scaling their positions over weeks, whereas retail moves rapidly. This speed gap can lead to market anomalies where an index rolls over because retail is selling faster than institutions can accumulate. End-of-quarter distortions are significant. When retail selling is fast and institutional bids are absent, we see exaggerated market moves like the ones we've just witnessed. This dynamic is a common feature of the market, not an anomaly. This chart illustrates the interaction between institutional and retail order flow over time, providing a visual look at how these two groups approach the market. Extremes in these readings mark zones, but the true inflection points are the crosses, where the two flows change direction. Historically, retail crossing down while institutions buy marks a top, while retail crossing up during institutional selling often signals a bottom or a stabilization phase. About a week and a half ago, retail crossed up, buying the dip aggressively, while institutions crossed down, selling slowly into that move. This configuration has historically signaled that a total market collapse is unlikely, and selling pressure is likely to subside. We also track the retail 0.5 line. When retail confidence dips below this level and then reclaims it, it often indicates downside exhaustion in the S&P. We have recently seen the index break below and then reclaim this level, which is a significant signal. The honest read is this: while we shouldn't bet blindly, we must recognize that retail is back in the mix. Institutions are selling slowly, as they always do. We don't want to fight this, but we also don't want to buy just because it's happening. To summarize, retail is loud and fast, while institutions remain quiet and methodical. The current crossover indicates that selling is likely to slow down. Respect the data, but do not marry it. This final point ties everything back to the shell game. During quarter end, institutional liquidity dries up, creating a vacuum. Combined with engineered fear, this led to the recent market flush. Nothing in the current flow indicates a crash. It points toward a market handoff. Finally, we apply our three-legged stool framework. Macro tells us what is happening, fundamentals identify who is affected, and technicals dictate when to act. This concludes our review of the market mechanics. Let's explore the fundamentals and who is affected. Key factors include P/E ratios, revenue growth, and debt. Macro conditions like interest rates play a critical role here. For example, heavy debt combined with rate hikes creates significant problems, while rate cuts may lessen the burden. A change in leadership can also rapidly shift market perception. Next, we examine the technicals, or when to act. This includes indicators like support and resistance levels, moving averages, and momentum. While fundamentals may suggest a trade, technicals tell you when the market is ready to agree. Technical setups are often the primary driver for short-term market moves. It is crucial to remember that not all legs of analysis carry equal weight. Sometimes, the market focuses heavily on macroeconomic factors like Fed policy, while at other times it is driven by technical mechanics. A key skill is identifying which factor the market is prioritizing at any given moment to avoid misdiagnosing a situation. Consider the example of Micron. Price movements often reflect technical trends rather than immediate fundamental shifts. Investors may love a stock during a run-up, only to claim they knew it would fall later. Recognizing the difference between a fundamental story and a chart-based argument is essential for successful trading. Walmart offers a different lesson. Its decline was a fundamental repricing due to management's decision to cut margins to gain supermarket share. The technicals eventually caught up to this reality. When fundamentals break without technical warning, the situation often worsens before it improves. When analyzing moves by prominent investors, like Michael Burry's shorts, it is important to distinguish between technical and fundamental logic. His arguments are often based on technical chart distances rather than business deterioration. Always separate market flows created by high-profile commentary from actual fundamental research. Our approach follows a top-down strategy: index, then sector, then individual stock. Even the best company can see its price drop if the broader market is selling off. We identify the health of the index, the sector's posture, and finally select the strongest or weakest names within that sector. Part 5 of this video looks at Meta's strategic shift. It is a significant change in business direction, moving from social media to competing in the complex world of cloud infrastructure and AI compute capacity. Rumors surfaced that Meta intended to enter the quote neo-cloud business by renting out its AI compute capacity. Zuckerberg's comments later confirmed this ambition. However, the market reaction was skeptical, as competing in this space means taking on incumbents with over a decade of experience. Meta's price and PE ratio show clear signs of market skepticism regarding its heavy capital expenditure. A brief price pop was quickly rejected at the 55-day moving average, signaling that the market does not yet trust the company's new strategic direction. Meta is trading at roughly 17 times earnings, one of its lowest multiples in years. This compression isn't necessarily due to poor earnings, but rather a lack of trust from investors regarding where that cash is being allocated. The market's rejection of Meta's recent rally acts as a polygraph test for its new strategy. Investors were hoping for disciplined capital expenditure, but instead, the company signaled increased spending. Price action has confirmed that the market is not yet convinced by these new initiatives. There is a clear divide between what shareholders want and what they are receiving. Investors would prefer a focus on ad revenue, dividends, and share buybacks. Instead, Meta is prioritizing massive infrastructure spending and competing in lower-margin business lines. This scenario echoes the company's previous pivot to the metaverse, where billions were invested with little revenue to show for it. Whether it is sunglasses, AI, or cloud infrastructure, the primary frustration for investors remains the company's continuous search for ways to spend profits rather than returning them. Ultimately, the bull's lament is straightforward. Meta generates substantial profits from its core business, but leadership repeatedly finds ways to invest those earnings into massive, uncertain projects rather than returning value to shareholders. This video examines the massive $700 billion capital expenditure pool for AI infrastructure expected by 2026. Meta's share alone is significant, and if they choose to reduce this spending, it could create ripples across the entire sector. The core question remains: will Meta cut back, or will they leverage their capacity? If Meta scales back, suppliers face earnings risks. However, if they successfully rent out their infrastructure, spending might actually increase, though that could drive down rental prices. We must consider the margin trap. Meta's core ad business is a high-margin machine. Shifting focus to cloud infrastructure rental introduces them to a lower-margin, capital-heavy, and brutally competitive market, which is a major strategic gamble. If Meta does cut capital expenditure, a chain reaction could follow: lower hyperscaler estimates, compression of semiconductor earnings, increased competition for pure-play clouds, and declining DRAM prices. Currently, this is all based on rumors. While much of the market noise is just that, noise, some of it has real consequences. When a giant enters a smaller player's arena, or a customer becomes a competitor, it represents a fundamental change for those specific businesses. The skeptic's perspective argues that Meta's commitment to this space may be short-lived, while established players like Amazon and Google have long-term structural advantages. A single uncertain entrant does not necessarily define the entire cycle. Next, we look at the collateral damage. When business relationships shift, financial charts often reflect the impact before news is confirmed. It is a vital indicator of market sentiment and fundamental health. This chart highlights the businesses most affected by these market shifts: serving as a reminder of how quickly sentiment can turn when exposure to specific large-scale competitors is realized. CoreWeave is one example of the pressure. With Meta as a client and potential competitor, the company has seen significant selling. Combined with recent insider selling, this name serves as a cautionary tale for those attempting to catch a falling knife. Nebius faces a different test. As a niche provider, they are now feeling the weight of a giant competitor. The stock's performance near the 55-day moving average is a critical indicator of whether this represents a temporary shakeout or a permanent repricing. IREN is another company caught in the crossfire, punished simply for being in the same sector. In times of fear, the market often sells entire categories indiscriminately, which can create opportunities for those who distinguish between the tourists and the real businesses. Looking at companies like Micron and KLA Corporation, the recent volatility is largely technical, not fundamental. Despite the sharp moves, the underlying business conditions, such as high DRAM pricing, remain intact. This suggests a technical resolution is more likely. Now, we turn our attention to the winners. Market movements are often a process of rotation rather than a complete exit, highlighting the importance of identifying areas where capital is flowing instead of fleeing. This data visualization shows the relative strength across various sectors. Tracking these winners is key to understanding where the market is finding value and growth, despite the broader sector-specific concerns. Biotech has seen an unequivocal tear, with pullbacks appearing very brief. For traders, this strength offers a unique opportunity to utilize leveraged instruments, or inverse ETFs, to capitalize on the momentum while managing decay risk. Let's pivot to healthcare. With the XLV sector breaking out, we are seeing signs of a defensive rotation. This is often a signal that capital is seeking stability, which is worth watching closely as market conditions evolve. When examining sector performance, we have two primary theories. Either we are seeing a genuine defensive rotation, or capital is simply rebalancing away from the crowded semiconductor space. Monitoring these shifts helps us understand the current market narrative. The XLP sector, representing consumer staples, is also moving upward. This movement confirms that the defensive bid is real. However, because the consumer discretionary to staples ratio is not breaking down, we can infer this isn't recession-driven positioning. The conclusion here is that we are witnessing healthy capital rebalancing. Funds are moving from an over-owned sector into under-owned areas, which is generally a constructive sign for the broader market. Moving to the financial sector, we see the XLF breaking out, suggesting aggressive institutional interest. Meanwhile, the KRE Regional Banking Index shows an accumulation fingerprint, where price dips are quickly met with buyers. Regional banks being bought on price undercuts is a strong bullish internal indicator. History suggests that if a systemic event were imminent, banks would be the first sector sold, not the one attracting this type of buying pressure. In the homebuilders sector, or XHB, we see a textbook bullish sequence, a breakout followed by a gap fill and a successful retest. This resilience is supported by a stable 10-year Treasury yield, which provides a favorable environment for builders. When we combine the strength in regional banks with the stability in homebuilders, the rate-sensitive complex is essentially voting against a recession. If credit markets were truly signaling trouble, this behavior would be absent. The industrial sector, XLI, is currently trading near its highs. This trend aligns with the dollar rolling over, which acts as a major tailwind for industrial exporters. Leading names like GE are also performing well, confirming the strength in the sector. Despite some recent noise surrounding companies like Caterpillar, the broader industrial and transport behavior remains robust. This is not the type of price action we would expect to see in a market poised for a significant downturn. The Dow Jones Industrial Average is currently printing all-time highs. It is worth remembering that markets typically do not crash while the blue-chip averages are hitting new peaks. Keep your eyes on the broader trend, rather than individual headlines. Looking at the semiconductor sector, the SK Hynix contract news is a significant development. With no price caps and ongoing investments in the trillion-dollar range, the supply-demand balance remains tight according to those closest to the demand. How does this cycle end? It will likely be signaled by a decline in capital expenditure guidance and a shift in DRAM pricing. We are looking for tangible, public data points rather than rumors or social media noise to dictate our strategy. Our playbook remains clear. Track key levels like the 518 to 519 range for the SOX index to determine the trend. We continue to rotate with the market, focusing on strength in industrials, healthcare, and finance, while maintaining patience with semiconductors. In summary, keep a close watch on DRAM spot prices as they act as the ultimate arbitrator for this narrative. While market noise is inevitable, following the institutional flow allows you to stay aligned with the actual direction of the broader market.